Good morning. I'm first going to do the theory of financial statements, and then I'll do separate questions to explain the different concepts and do a full question on financial statements. So in this income statement, please remember that some schools call it income statements, some call it statement of income, and the correct word according to IFRS is statement of profit and loss and other comprehensive income. So if you get any of these, it means that you have to do the income statement. Okay, so the purpose of the income statement is to work out what is the financial results, how much profit or loss they made in the business. If we look at the income statement of a service undertaking, they don't have sales, cost of sales, so they will just start with income and then other income, for instance rent income or commission received or whatever. And then the only difference between this income statement in a sole trader and partnership is that they will stop with profit, and in a company, after the profit before tax, you deduct the tax and then you show the net profit for the year. This net profit is the amount that will be divided between the shareholders or retained in the business for future expansion. Okay, if you look at the trading concern, it is just that sales less cost of sales gross profit that you've always done. Here again, you will stop in the normal income statement with net profit before tax. In a company, you will deduct the income tax, and the net profit for the year will then be used for the people. Okay, this net profit before tax, they can sometimes not give you all the information that must go in the income statement, and then they give you either this net profit for the year or the income tax or the profit before tax. So it means the profit before tax will be the 100%, the income tax is the 28%, and the profit for the year will be the profit after you deducted the tax. So when you do this question, you must read carefully what is given. So if they give you the profit before tax, they give you the 100, income tax 28.72. In this one, they gave you the profit before tax. So this one is the one that's given, the 840. So if you want to know what's the income tax, the one that I want, 28 divided by 100. And if you want to know what's the profit after tax, 72 over 100 times the amount. If they give you the net profit after tax, it means that this figure is now given. So if I want to calculate the profit before tax, the one that I want, 100 over 72 times the amount, and if I want the income tax, it will be the 28 over 72 to get the income tax. The third one, they can give you the net profit after tax. So they give you this answer, the income tax, and they say that is the 28%. So if I want the profit, it means that I will say 72 divided by 28. So you must just read very carefully what is given to you, so that you don't do the wrong calculation. So it's not always 28 over 100 or just 72%, depending on what was given. Okay, in the balance sheet, you will see that the balance sheet looks exactly the same as the balance sheet that you had in sole traders and in partnerships. The difference is these two that I highlighted. So it means you don't have income tax in sole traders and partnerships, so it was not included in the balance sheet. If you pay too much provisional tax, it means that SARS actually owes you money, then it's an asset to me, and that SARS income tax will fall under current assets. If you didn't pay enough income tax, the provisional tax, it means that you still owe money to SARS, and then you will write it under current liabilities to show this is money that will be paid in the future. Okay, so except for bank, where you sometimes have a favorable bank balance and then it will be included in cash and cash equivalents. If your bank is overdrawn, it means you owe money to the bank, then it will go under current liabilities. So that is 1B account that sometimes can be an asset and sometimes a liability. And the second B account that you have that can also be sometimes an asset or sometimes a liability is the SARS income tax account, because you can pay too much provisional tax, then it's an asset. You not paid enough provisional tax, then it's a liability. That's the only 2B accounts that you have that can sometimes be a current asset and sometimes a current liability. Okay, the next thing is this equity and liabilities. So the ordinary shareholders' equity consists of share capital and retained income. This share capital is your ordinary shares that you issued. Now, in a company, they have various different shares. You only have to do the ordinary shares, so you don't do any of the preference shares, so you will just show share capital. Retained income is the profit that was kept back in the business for future expenses, so it means that you will have money that actually belongs to the shareholders, but they keep it back in the business to use in the future. So this forms part of your ordinary shareholders' equity. So this is also something new that you haven't done before. Okay, the notes look exactly the same. For companies, you have to show a note for interest income and for interest expense, and then the others will be the same. Now, what's very important, according to IFRS, you have to show this income tax on the face of the balance sheet, but some of the schools still use it in the old way. Instead of putting it in the face of the balance sheet, they show it as trade and other receivables, or they show it as trade and other payables. So remember, both of them will be marked correctly when you write the matric paper, because the schools use different textbooks, and some of the textbooks are very old and they still use the old method. So both of them will be marked correctly. Just make sure that you don't put it in both places. So you have to decide, do I want to put it on the face of the balance sheet, or will I put it in the notes? So follow the method that the teacher uses in the school when you do this, because it will make it easier for you. Then the shareholders for dividends will always be a liability, because the interim dividend is paid immediately. The final dividend is declared at the end of the year, and they don't have time to pay it out immediately, so they normally owe money to the shareholders at the end of the year. This one again can either go under trade and payables, the note, or it can be done directly under current liabilities. This question I'm going to do separately. Okay, shareholders' equity gives an indication of all the shares that you are allowed to issue. So that would be your authorized share capital and your issued share capital. The shareholders' equity consists of the capital and the retained income, the profits that was kept back in the business. With the ordinary share capital, you are never allowed to write any amounts there, because you don't know how many shares will be issued. So it means for ordinary share, you show your authorized share and no amount. That means that This figure can never determine what is your capital value, because your ordinary share capital is the issued shares, and you will never use this amount to calculate dividends. The only place where you use this million is in your authorized share capital in the balance sheet. Okay, so this is never used for it. In the issued share capital, you will determine what is the value of your share capital. So you will look how many shares were issued at various prices, added together to determine what is the total capital. The dividends will be calculated according to this capital on the number of shares that was issued on the day the dividend was declared. Okay, this retained income is the profit that you will have to distribute in the future. So it wasn't paid out this year, and you keep it back for expansion. Okay, the retained income note, you will always start with the opening balance. Then you will take the net profit for the year after tax, because the profit after tax is the amount that belongs to the shareholders. That profit we take dividends. Remember, the dividends must be in brackets because you take it out of the profit, so it decreases my profit. The amount paid is always your interim dividend, because it's declared in the middle of the year and it's paid immediately. The recommended one is always your final dividend, and normally you haven't paid it. But in your retained income, we have to show what is the total amount that will be paid out as dividends, whether you already paid it or not. So it means that total amount will decrease my retained income in the balance sheet. Okay, the income tax in South Africa is 28%. Sometimes the schools use 30% just to make the calculation easier. The income tax in the middle of the year, you do a small income statement, determine the profit, work out 28%, and we send provisional tax to the government. Okay, that means the bank is credited, the account that's debited is SARS income tax, to show that we pay some of our debt at SARS. Then at the end of the year, you do a calculation again before the adjustments is done, and we send provisional tax to them again. Then after this was done, your books go to the auditors, and as soon as the auditors are satisfied that everything is correct in your financial statements, the actual profit for the year will be calculated, and then for the first time you can calculate the income tax. So as soon as the final profit is determined, this is the first time that you will write in your income tax account, never before that final amount. And then we will show that we owe this final amount to SARS for income tax. So the reason why you put the income tax in brackets is that we have 3 SARS accounts in our business: a SARS for VAT, SARS for pay as you earn, and income tax, and we can't mix those accounts, so each one of them must be kept separately. The income tax account balance will then be closed off to the appropriation account to show that the income tax is deducted from your net profit. The dividends on ordinary shares is the amount that you divide between the shareholders for the capital that they provided to the to the business. So we take the profit and we distribute it to the shareholders on the number of shares that they have. So the more shares I have, the bigger profit I will get. And this is a liability to the business if they haven't paid it yet. So the interim dividend will always be in the middle of the year, and it will always be paid immediately. Only the shareholders that's listed in the company's books on the date the dividends is declared will be entitled to a dividend. So say for instance we declare an interim dividend on the 31st of August, then all the shares that was already issued will receive that interim dividend. The shares that, say for instance we issue shares again on the 1st of September, will not be entitled to this dividend. The final dividends will always be paid at the end of the year, and it will be again paid out to the people who have shares on the last day of the year. Sometimes when there's a repurchase of shares just before the end of the year, they will tell you that those people are still entitled to the dividend. But normally it will only be the people who still have shares in the business. And then this ordinary share dividend account is debited and the appropriation account is credited. And then we will take this to your appropriation account to close off the dividends. If we look at these two appropriation accounts, that you do a trading account, sales, cost of sales, and you calculate the gross profit. Then in the profit and loss account, you add the income, subtract the expenses, and we calculate the net profit. And that net profit is then transferred to the appropriation account. Out of this profit, we first of all pay tax, and then we determine, okay, how much money do we have left over, and then you decide what the dividends will be. And if you don't pay out all the money, you create a retained income account where you keep some of the profits back. If we go to the second year, I will again transfer my profit from a profit and loss to the appropriation. Then this retained income that I had at the end of the previous year will then be transferred to retained income in the appropriation account. So if they ask you how much money do they have available to divide between the shareholders, it will not only be the 300,000, it will be the 361,500. On the 300,000, I will pay income tax. Then I say, okay, how much money do I have left over? And I close my income tax and ordinary share dividends account to the appropriation account, and then I calculate what is my retained income at the end of the year. So if we look at the retained income at the end of the previous year, and I look at the retained income at the end of the current year, I can see that it increased enormously. So that means that the business kept back a lot of money in the current year to expand, for instance, in the future. Okay, the repurchase of shares can be done in 3 different ways. The first one is buyback at the issued price. So if I sold it at 2 Rand, when I buy it back, I also pay back 2 Rand, and I reduce my capital account on the debit side with 2 Rand. Buyback at average issued price. So it means I sold shares at, say, 2 Rand, 100,000. Then I sell 100,000 again, but at 3 Rand. So the average price is then 2 Rand 50. So I take my capital value and I divide it by the number of shares, and I will take that average price away on the debit side of the capital account. The third one is higher than average price. Now what I put in my capital on the credit side, I can never take more out of my capital account on the debit side. So if I give a price that's higher than this average price, that additional amount will go to the retained income account because you take it out of your profits. So only the average price can go to the debit side of capital. The amount above the average price will go to the debit side of retained income. The final accounts are prepared with a double entry principle, so it means I close off all my nominal accounts and I transfer it to the trading profit and loss account. The financial statements is not part of the ledger. It is not done according to the double entry principle. It's done in columnar form so that it's a statement, but exactly the same figures that you will have in your ledger you will have in your financial statements as well. Okay. The final accounts are always just prepared at the end of the year, where the financial statements can be done any time during the year to determine what is the profit, can we expand, can we pay out extra things or whatever. The final accounts, you close with the nominal accounts and you work out what is the financial result or the profit. In the financial statements, you actually draw up to report and plan for the future and to control the money. Okay, the trial balance, it's very important that you must be able to distinguish between these three trial balances, because that will indicate to you whether they've already completed the entries or not. So pre-adjustment means it's before the adjustments must be done, so it means you have to do the adjustments. Post-adjustments means after the adjustments were done, so you don't have to do the adjustments. Sometimes they will just tell you that the following three entries were not done, so that's the only three that you will then do. The post-closing trial balance is after they closed all the nominal accounts to the profit and loss account. So it means the only accounts that's left in this trial balance is your capital and retained income, that's your equity accounts, all your asset accounts and your liability accounts. There will be no income and no expenses in this post-closing trial balance.